Starting now.
All right. All right, everyone. Thanks for coming today. My name is Kyle. I'm from NinjaCators. Today, we're going to go ahead and talk about a tool that we offer from NinjaCators. But before that, we're going to go ahead and get into some Elliott Wave here as well. And I'm sure you've been beaten over the head between Fibonacci and Elliott Wave all day. So some of it will sound a bit repetitive, but I'm sure we got some new people in here as well. So we'll go ahead and get started now. As far as the chat goes, hopefully I have some time at the end to answer some questions. I'm not going to answer questions as we go through this for the simple fact it'll distract me, get me off my train of thought, and then we'll just be kind of out there in the wilderness there. So I'm going to go ahead and close the chat. I will reference to it at the end, however, but if you have questions and you throw it in there, I'll try to circle back and answer them. All right, guys. Well, once again, welcome. Before we get into anything, I must remind you that trading does carry significant risk. All information in this video today is provided for educational purposes only. It's not an offer or recommendation to trade future stocks, options, or Forex. All right, so let's go ahead and get into some background here. Again, this may seem a bit repetitive. Our goal here at NinjaCators, and my goal really today, is to try to make things, try to make Elliott Wave as simple as possible. You know, if you want a PhD, for instance, in Elliott Wave, we could be here for the next couple of years, going through the encyclopedia of Elliott Wave and looking at every little subwave and breaking down everything like that. But we're not going to do that. I'm trying to make it as simple as possible to get you up and running and trading as quickly as possible using this methodology. So, you know, if you're looking for extreme in-depth analysis with Elliott Wave, only got an hour, you can always go ahead and shoot us an email to answer any of those questions, and we'll always get back to you. Don't leave any question unanswered, but if I'm kind of glossing over something and I don't get your answer to you right away, just go ahead and shoot us an email. We'll always get back to you with the answer that you're looking for. All right, let's go ahead and get into some background. So as far as Elliott Wave, it was a technical analysis that's based on crowd psychology and pattern recognition that can be visualized in waves. Now, the inventor of this, Ralph Nelson Elliott, recognized that these waves are fractal in nature and form larger and smaller versions of themselves. Whether it is Fibonacci or Elliott Wave, kind of, you know, married the two there, but you know, fractals, this stuff's all in nature. You know, you go to the beach, you see waves kind of coming up, you see waves receding, right? He thought that there was a pattern in absolutely everything in life. I try to look for pattern in my kids. Don't really see a pattern there. They're just kind of impulsive. They're just in that impulsive wave all the time. But otherwise, you know, he's always looking for any type of pattern to go ahead and take advantage of. And that's, you know, when you talk about the human condition, that's what we all try to do. Is the easy way to go through a situation is to apply a pattern, something that we've recognized before, so we don't have to go through the whole researching and you know, trying to figure out what's going on and trying to get in the background or anything like that. We want to know that we see something, you know, we just act on it. For instance, like driving. When you first get in the car, you know, you get in the car and you're thinking about everything. You're learning how to drive. The wheels start moving. You know, how much pressure do you put on the accelerator? You know, depending on what kind of car you're driving. Obviously, if you're driving a Ferrari, you don't put too much pressure. If you're driving a pickup truck, maybe a little bit more, right? You start, when you're first starting out, and this is so true in Elliott Wave, you know, there's so much to take in that it can be a little bit overwhelming. You're really not sure, you know, is this an impulse wave? Is that a corrective wave? You know, should I push this accelerator a little bit harder? Should I take this trade? Should I stay away because I'm in a corrective phase here on this other trade? Kind of, you know, it's kind of the same thing with driving, but over time, after practice and repetition of repetition of repetition, our brain starts coming up with these patterns. So you get into, you know, a couple of years later, you know, maybe even a couple months later, it's just second nature to you. You get in the car, you recognize a few, you know, your body just goes into, you know, automatic mode where you just know exactly what to do, what buttons to hit, you know exactly how to drive, and you're not even thinking twice about it. You make these subtle micro adjustments as you go on throughout the day, but your brain has come up with these patterns that your body just relies on here at this point. And that's exactly what, Ralph Nelson Elliott, what he was going through is that, he saw that he's like, everything has to have a pattern. And especially when it comes to the market, it's being traded by people. This is back in the 30s, mind you, but it's being traded by people. It's all about crowd psychology, and people have a nature to them. They have a pattern. There's fear. There's traders that are just exhilarated. They're just going to go ahead and jump into a trade, right? There's excitement into a trade. Well, he identified these patterns and put it all together over his time. But the primary value of the wave principle is that it puts price action into context. When you're looking at a trading, when you're looking at Elliott Wave, a lot of traders instantly think it's, a trading system. And by rights, you can turn it into a trading system. But its primary value is to give you a roadmap, right? So when you look at the market after repetition and practice and looking at charts over and over again, you start instantly recognizing patterns in the market. You start instantly recognizing that roadmap that, maybe you want to lean into this trade because you're in a wave 3 impulse wave. Maybe you want to go ahead and scale back because you're in a corrective 4 wave, right? Maybe you're in an ABC wave. So you want to go ahead and maybe not put smash the accelerator down, right? You want to go ahead and ease back on that trade. So it gives you a bit of a roadmap, tells you, times where we really need to lean into a trade, and then times where you really need to go ahead and scale back. So it gives you that context, kind of gives you a roadmap. Now it has multiple benefits. It can identify trends and counter trends, signals the resumption and end of a trend, and provides high probability entries and targets. So when you're first stepping into the arena of trading, especially when you're starting to look up Elliott Wave, it can be a little daunting. It can be a little overwhelming. I mean, there's guys that go to school for years to learn Elliott Wave. They can spend a lot of time in this. But when you come out on the other end, when you look at the market, you can quickly identify areas in the market that you want to trade and areas in the market that you want to go ahead and avoid. You can quickly tell if there's a trend going on, but most importantly, you can start identifying high probability entries. The key goal of Elliott Wave trading is to take advantage of those impulsive 3rd and 5th waves while also trying to take advantage of the quick A and C waves as well. Now, I know there's other ways to go ahead and trade Elliott Wave. I know there's a lot of different ways to trade it depending on your goal in trading, whether you're a swing trader, scalper, or if you're a super Elliott Wave person that knows everything in and out. There's other ways to go ahead and trade it. But again, what I'm trying to do, my goal today, again, is to break it down and just make trading Elliott Wave as simple as possible. So we're going to be focusing a lot on the 3rd and 5th waves and the A and C waves. So let's go ahead and start breaking the Elliott Wave down. So here's an impulse wave, just a downward impulse wave here. Again, we're going to keep it very basic, very high level. All right, you can clearly see that we have, you have the first leg down. You have we call these connector waves or correction waves, but it's connecting, 1 to 3. You can see that you have the big 3 impulse wave here, the corrective 4, and then the 5th wave that goes ahead and ends it out. So what we're trying to take advantage of is, again, this impulse wave that you see here. Now, the 3rd wave is ideally the wave you want to go ahead and take advantage of. And you can typically do this now when, if you're going back to Elliott Wave, it's typically done on the higher time frames. Way back when they were trading it, it was, typically done on a daily time frame. You can apply it on smaller time frames. It just gets more complicated. Because the market will move, especially on a 5-minute chart or 1-minute chart, it'll start moving in fits and starts. And sometimes you get in the weeds a little bit. You get a little bit confused as to what's going on. If that's the case, you just need to kind of back out and go to a higher time frame. But again, the market moves fractally. So sometimes if you go out to, let's say, a 15-minute wave, or 15-minute chart, excuse me, and you see that you're in an impulse wave, you can go ahead and zoom down to a 5-minute or 1 minute to start looking for an entry. But the easiest way to take advantage of Elliott Wave is looking for these impulsive waves and taking advantage of them in the market. We have a strategy that we'll go through here towards the middle end, and to kind of, actually towards the middle there, and kind of break it down for you. All right, here is another example here on a currency. Again, you can apply this to any market, really any time frame that you like. A lot of Elliott Wave traders will use 30-minute, 60-minute daily. But here again, you have impulse wave 1, corrective wave 2, impulse wave 3, another corrective wave 4, last wave here 5, and another impulse wave. And then you have a corrective wave, the ABC wave. Now you have sub waves within the waves. Again, I'm trying not to get too in depth and get you too in the weeds here, trying to keep it as simple as possible. But you have, you do have sub waves within the impulse waves. You have sub waves within the corrective waves as well. But again, just focusing on the bigger picture here, this is ideally what you're looking for. You know, you want to see an uptrending market. You want to see a market that's, you know, has any type of trend to it, whether it's higher or lower. You know, when you start getting confused, you start getting in the weeds a little bit when you start applying this to more of a choppy market, a sideways type of market. If it's trending higher, then this is exactly what you want to see, the kind of uniform symmetry going on here in the market. Now, there are different types of corrective waves, and we actually have those broken down here. Now, I didn't hear the complete last session that you had there, but I caught the very end. He's talking about corrective type of waves, and here's just another different breakdown of it. First, you have the zigzag type of correction wave. All right, this correction is very sharp against the prior impulse trend. Wave B is usually the shortest compared to A and C. And within one overall correction, you can spot multiple zigzags linked together. Sometimes it's a correction. Sometimes they can get a little bit ugly. Well, this is ideally what you want to see is a formation over here on the right, the ABC formation. You have another corrective type. You have a flat correction. Instead of making a sharp move to the reverse of the impulse waves, price simply decides to go ahead and grind along. Now, each of the ABC elements of the wave are pretty much equal, and be prepared to ride out a grinding wave until a clear direction is identified. And then finally, you have that triangle wave, where it's an impulse trend line starts to converge or diverge, giving you a triangle type of correction. And you want to look for expanding or contraction correction waves moving in the opposite direction of the prior impulse trend. Now, for me personally, whether you're trading stocks or futures or anything, obviously you want a market that's trending higher or lower, but you want some type of direction there in the market. But my favorite type of correction is actually the flat correction. The reason I like the flat correction is simply because the market is moving higher. It is correcting to the side, kind of grinding to the side. The pullbacks are, typically I'm talking about more from a long perspective. The pullbacks, every time it dips down, gets bought up, and price is maintaining near those highs. You might have a slight deeper pullback than expected, but for the most part, it's maintaining near those highs. At that point, I'm looking for a breakout, to the upside and a resumption of that move. Now with Elliott Wave, let's go ahead and roll back here for a second. Now with Elliott Wave, if you have a corrective move, there we go. If you have a corrective move and you breaks the bottom of this fourth leg here, then you'll probably you need to start looking for more of a reversal type of trade. But in a flat correction, you're pretty much moving higher. And if I can go ahead and grab my pen here for a second, you're pretty much moving higher. And if you have a flat correction, you're kind of moving to the side here. And those are the trades I really like to take, especially on breakouts and looking for that next leg higher. So if I'm looking at a formation that I like, a corrective type, it's typically that flat correction. Now there's other traders that like that zigzag correction. And the reason they like that zigzag correction is similar to this here, is if it's more at more to value down here, right? The zigzag correction, you have a nice move higher, pulls back, and they want to go ahead and take the pullback. And that just comes down to, you know, who you are as a trader, in my opinion. If you're a patient trader and you don't mind taking some drawdown, if you don't mind, you know, living through the chop a little bit, then being a value trader looking for it to pull back a little bit deeper than expected and trading those pullbacks, you know, maybe you're a patient trader. You don't mind kind of going through that grind. However, if you are a breakout trader, if you don't like, you know, drawdown as much, you want to minimize drawdown and you know, possibly take on a little bit more risk, then you'd probably like the flat corrections a little bit more like me. I like those momentum trades. I like it, you know, catching, you know, being, as one trader used to say, kind of being a flea on a dog, right? He's kind of sitting in the grass, dog runs by, and he just jumps on for a ride until he gets kicked off, right? I like that momentum. And so I am, you know, while I'll go ahead and execute trades on a pullback if everything is lining up, I actually prefer the flat corrections because those have some momentum built into it. Whereas I have to go through probably a little bit of chop, and the risk reward is obviously there's bigger payoff there in the value, obviously, but I minimize my drawdown. I'm trading with the momentum with that flat correction. All right, there we go. Let's move forward here a little bit. So here we are on ES. This is just something, you know, just kind of take everything. I've been talking kind of an abstract, showed a couple of different examples here, but this is from the ES just 2 days ago, I think, as an example, and it's on a 5-minute time frame. And, you know, just as a word of caution, you know, when you're trading Elliott Wave, it's, you know, in my opinion, is better to apply it to higher time frames. It's easier to apply it, if that's a correct term I should use, to apply it on higher time frames, just because it's simpler. You don't have as many gyrations in the market. Again, on lower time frames, the market kind of moves and fits and starts, so it can get pretty confusing at times. At other times, you know, if you find that the market is fairly choppy on a higher time frame, sometimes going to a lower time frame, you might find the market is a little bit cleaner. You know, and when you're trading in between a range on a daily time frame, on the lower time frame, you know, they actually might be nice trends going on. So at any rate, here it is on it's just a couple days ago. We have the ES, and you know, maybe right away, maybe you're trading Elliott Wave here for a little bit, and maybe right away you'd be able to identify, you know, the trend or identify the waves here in the market. So we start out down here in the bottom. We have the first wave here. The second wave, kind of had a little sub wave right there. Here's the third wave. Sorry, mouse froze there for a second. Fourth corrective wave, and then the fifth wave. Then we had, I believe, a little bit of a flat correction there. All right, so you had one, completion of one, completion of two, sorry for my writing, completion of three, completion of four, and five. All right, then you went into a corrective wave. Now in a higher time frame, let's say on a 60-minute time frame, that, you know, the market's choppy, it might have been a little bit difficult to see. But here on a lower time frame, it was actually pretty simple. And in a trade like this, what I'm specifically looking for, you have this one after the second wave right here. In typical Elliott Wave fashion here, you're looking for the breakout trade right there. That's typically where you go ahead and execute the trade. And now stop placement is up to you as a trader. Now, if you're trading by pure Elliott Wave standards, and you go ahead and put it on the bottom or right below this wave down here. Let's go put it right there. If you understand breakouts and you're comfortable with it, and you have a strong breakout candle like you see here, and you're confident in your wave count, I would actually execute the trade, maybe not put it right underneath here, but look for an impulsive candle a little bit further back and tighten up the stop here. All right. Now, I am typically more of a price action trader, so I look at price action quite a bit. The waves give context, and then your execution is through price action, right? So typically this would be the entry on the breakout on the high of wave 1, stop right below there, and then you can see how this one worked out. Now you have another trade possibility here on the breakout of wave 3, which would be right through here. Nope, not the strongest breakout. I'm not a fan of that kind of pullback. All right, and your entry would be there. Again, stop on the breakout candle. Now typically, if it's Elliott Wave, you want to put it down here. But you could try and trade that breakout there. And again, this one, you'd only squeeze a few ticks out of the market. And at the very end of the day, it'd either be a scratch or a small loser here on the trade. All right, but just taking everything I was talking about, impulse waves, corrective waves, trying to put it into a chart, you can kind of see it right here. And this is just, I believe, on the 3rd, so that was 2 days ago. All right. Oh, apologies. Hold on one second. All right. All right, so we're gonna go ahead and break this down into rules before we get into the strategy. Rule number 1, trade with the impulses to start. Remember that the volume driving the buy or sell action is driven by a force much larger than you or your account. So what this means is if you're trading with the impulse, you're trading with the trend there, you're also trading with a lot of breakout traders, with institution types of traders, right? They're looking to get on these trends. They are looking for these impulse waves to go ahead and take advantage of on a day-to-day basis. So if you put volume with it, or maybe have another type of oscillator that tracks volume or buying activity, maybe order flow or anything like that, trade with the impulses. And if you see a volume size breakout, so you see a breakout that's backed by volume, then you're on the right side of the trade there. You have context there. You have your roadmap set with Elliott Wave. You're looking for that impulse breakout. You get that impulse breakout, like that first trade that we were talking about here a second ago, and you match that with volume. And then you're, again, trading with a force much larger than you or your account, like banks, institutions, and whatnot. Rule 2, when in doubt, pull back. If you're not sure what direction the wave is going or what phase it might be in, impulsive versus corrective, simply pull back to a larger time period. I can't say this enough, especially with beginner traders. And there's a huge influx of beginner traders that flowed in since March, since the whole COVID pandemic has started. Everybody wants to be a day trader, and everybody wants to trade, make that big money, make it real fast. So what do? They try and trade in the 1 minute, the 5 minute, because quick profits, right? Quick trades, quick profits. Now, if you're applying Elliott Wave there, especially for the beginner traders out there, and you're trying to take advantage of everything, and you're just looking at a chart one day and it's nothing but chop, but if you look at it sideways, if you stand on your head, you might see a trend there. So you go ahead and execute a trade. I mean, I've heard it all from traders, right? We go back and look over trades, and it completely violates the rules. There's no wave count there. There's no impulse candle. Whatever the case is, they just have that need to trade, right? That FOMO. But I can't say this enough. If you have a doubt about, the wave count, where you are, if you can't really identify what's going on, pull back. So what would that mean? Well, if you're on a 5 minute, go to a 15, go to a 30 minute, go to 30 minute and see, if you can see the trend there. Over my time, I'm a lot more risk averse than I was when I started out. I wanted to trade everything, right? I wanted to trade everything. I've always felt like I needed to be into something. But over time, I realized that it's the quality of the trade, the quality of the setup versus the need, versus the need to be into a trade was much greater. So if you're on Elliott Wave can be very confusing on these lower time frames. You know, if you go to 30 or 60 minute, it cleans things up quite a bit. Now, sometimes it could even get confusing there because the market's just, you know, just in chop. There's really not a lot going on, not a whole lot of catalyst, whatever the case may be, the market's just kind of stuck in neutral. All right. In that case, you know, maybe it's one of those times you're just going to have to sit on your hands, right? Keep your powder dry, you know, wait till next week till the market gets a little bit more directionality to it, gets a little bit more, get a little bit more movement to it. So again, when in doubt, just go ahead and pull back, look at a higher time frame. Remember the Elliott wave was typically geared for those higher time frames, you know, those daily time frame, more of a swing trader type of thing. Now, again, you can apply it to lower time frames, but it can get quite confusing. So just pull back. You know, there's no shame in that. Rule 3, repeating patterns doesn't mean repeating trades. Just because the market follows the pattern of impulse followed by correction doesn't mean that you should be trading every impulse or correction that you spot. Trends do die out. Trends eventually do die. Not if you're in gold, apparently. But otherwise, you know, trends eventually do die. And you can kind of see that coming because, you know, what this really means is that you know, there's going to be times, let me see if I can draw it here without looking like chicken scratch. There could be times where you had this big move, corrective wave, big move, corrective wave, and then you start getting, you know, it's making higher highs and higher lows, right? But it's kind of losing its momentum there. All right, there's going to be times where you have these big impulsive moves, you make a lot of money, gets corrective, it goes into a correction phase, you know, you execute the trade, you know, you do really well. But, you know, if you're not paying attention, you may not notice that those impulse waves aren't going nearly as far as they were in the past. You know, trades 1, 2, and 3 look great, right? But, you know, you're not making as much in 4 and 5, right? The market's losing momentum. So eventually, the market will have a pullback. Every time the market starts to move higher, you know, pullbacks and deeper corrections than expected are, you know, should be expected in the market. That's a natural phenomenon, right? You have buyers pushing up the market, and then seller, you know, eventually buyers start to, you know, get a little fat. They're pretty happy at that point, you know, and their pockets are padded, and they start, you know, maybe they're not playing in the market. You know, there's a lot of different reasons, but just using it as an example, right? Sellers start to come in because they start seeing opportunities, start to see momentum coming into the market. And then the trend is higher. So eventually the buyers come back, see it at a value, and then start pushing it higher, right? So you may get, you know, at the end of this, you may get a correction that looks something like this, right? A little bit deeper correction, right? But just another opportunity to go ahead and buy towards the upside. So again, there's going to be markets that really trend really well. Doesn't mean those trends are going to go on forever, but just kind of a rule of caution that we've seen play out. Finally, rule 4, keep it simple. And that's what I've been trying to do throughout this. I may be confused here, a few people here a little bit, but keep it as simple as possible, right? Many traders are on the lookout for so many different formations that their chart becomes a jumbled, meaningless mess. I've seen this quite often, especially new, even, you know, traders that have been in it for a little bit. And you look at their chart, and it looks like my kid's Etch-a-Sketch, right? You don't know what's going up. You don't know what's going down. I just don't even know what to say, right? Elliott Wave can do that. It can actually do that to your brain, where you're not sure, you know, what wave that you're in, right? And again, if that's the case, back out. You know, look at a higher time frame. You know, going back to, I believe it's rule 2. But more than anything, and you know, even if you know, let's say Elliott Wave's not for you, you go move on to something else, right? Whatever you do in trading, keep it as simple as possible. The human mind has a way of overcomplicating things and over optimizing everything. Sometimes, and I've seen this happen, traders actually have a pretty good system, right? They're actually making money. They actually have a month of consistent profits, right? They go into the next month and they're actually doing pretty good. But what they start noticing is that, I am doing pretty good, but I want to try to minimize my losses even more. Or I want to maximize my winners even more. And what they're doing is they're over optimizing. I mean, I'm sure there's a bunch of you guys that have done this. How many times have you guys taken an indicator and you put it on your chart? I don't care what it is. And like, oh, that's actually looking pretty good. It's catching those lows there. Oh, it's catching those highs there. But what if I adjust this number a little bit? What if I adjust that number a little bit? And you're like, oh, it's actually looking pretty great. Then you go to actually trade it, and it actually starts blowing up in your face. You don't get it, right? What's going on, right? Traders will just overcomplicate, try to over-optimize a system, and they end up messing up a pretty decent system, right? What's that saying? Don't sacrifice good for perfect. And there's no perfection when it comes to trading. I haven't seen a perfect trader out there. There's some traders that talk about being perfect. I actually never seen it, right? There's good and bad, right? Don't over optimize and try not to over complicate your trading. All right, so we do have a tool that kind of helps you identify these waves. And we're gonna go ahead and get into it here in a second, but this is just an example strategy of what we teach in the indicators here. We have a lot of different strategies, swing strategies and whatnot, but this is just a kind of a step-by-step guide. Again, we're trying to keep things as simple as possible. We tell them to go ahead and open up a 15-minute chart. We have an Elliott Wave tool that actually identifies the waves for you. Again, try to keep things as simple as possible. What we're looking for is the impulse waves in the market. We'd like to go ahead and get those corrective waves when we can, when they're clear. They kind of stand out. But sometimes they're not always there. So most of our trades, are more of the impulse nature. All right, we'll talk about the swing strength here in a second. You want to identify the overall trend in the market using Elliott Wave analysis or just pure observation. You want to see the market moving in a direction, right? You want to see it moving at a healthy 45-degree angle or in an impulsive manner. You just want directionality in a market. Nothing worse than trying to apply Elliott Wave in a choppy market. All right, you're going to identify and locate the end of wave 2 or 4, while also identifying if it's in a pullback area or price zone. We'll talk about that. I know this is kind of getting ahead of myself here a little bit. Once it enters a price zone, provides either rejection through candlestick analysis or strong move and close out of the zone. You have two different ways to enter. You can either do that, or in classic Elliott Wave trading, you can also enter at the breakout point of the high of wave 1. All right, we're always looking for a target of at least 2 to 1. Or you can use the tool's Elliott Wave projection zones. The projection zones, when it comes to Elliott, and if this comes back down to classic Elliott Wave and you're trying to project out where a wave can go ahead and go, just uses Fibonacci extension and Fibonacci analysis. So all that, let's go ahead and actually get into what the tool is actually looking for. There's a couple of setups that we are looking at here in the past and that worked out. So just a couple examples. All right, so you can see the tool plots out the wave for you. This is the price reversal zone that we are looking for price to come back into. Now, again, this is based off of Fibonacci numbers and Elliott Wave theory. So ideally, what we'd like to see is the price actually come back into the zone, touch the zone, and then start to move off. Now, we know with trading, and with Elliott Wave, doesn't always happen like that, right? Again, can't sacrifice good for perfect. So what do you do at that point? It doesn't hit the price zone, so where's your entry? Well, your entries just fall back on the classic Elliott Wave analysis. Look for the breakout point of high of wave 1, and we get that. The risk here is 80 ticks, because in the classic Elliott Wave, you want to go ahead and put it beyond the bottom of wave 2. And you can see the target up here. The potential target, I should say, is 145. Now, you want to get 2 to 1, but as you can see, we start getting into a corrective wave up here at the top. And at that point, it's time to go ahead and close out the trade. Now, again, we always have that goal. It doesn't always mean we're going to meet that goal, right? It's trading. Sometimes it'll go ahead and move in that direction. It doesn't always get to where you want, right? So you're not going to be a stickler and just look for that. You're going to go ahead and look at the chart, look at what's in front of you, and make those adjustments. All right, so you go ahead, you have the potential for 145 ticks, but it gets into that corrective wave there, corrective four wave, which is a flat correction. and then it goes into that wave 5. And then you have another potential breakout to occur actually right there. And this is more of a flat correction that you see there. Here's another example here. Oh, excuse me. You have, again, you have the price zones, the plots right there on the chart. You have the projection zone actually right here. So you have these red zones that are potential entry zones that we want to look for price to come back into. Again, all of this is based off of Elliott Wave analysis. And so we want to see price get into that projection zone. Didn't get into the zone, so we want to look for a breakout. We get that breakout right there. Again, risk is down to the low here. All right, and then you can see 120, again, 2 to 1 was right there. You had the projection zone plus the 2 to 1 plus the target zone there that it went ahead and hit. Now this one here, the second opportunity here, you actually had a bounce into the zone here. And so once you start moving out of it, it's kind of hard to see, but you had a kind of a strong candle right through here. So you'd go ahead and enter right there. And you can see your risk is down here at this point. All right, and you can see you got your 2 to 1, and it went to the second projection zone right here. Now, these two trades here are pretty textbook, right? This is what you want to see, right? You get a breakout, get another impulse move here. You go ahead and go long, get your 2 to 1, you hit your target, you kind of reset, wait for the next impulse, or you wait for the next pullback to go ahead and get long. Get long again, hits the next target, and then starts to pull back or goes into more of a corrective phase or reversal phase at that point, right? This is probably a chart you would put in a textbook, right? But again, when it comes to trading, it doesn't always work out like that. But this is ideally what you want to look for on a trade. Another example here, again, the break of a high of wave 1, nice entry there. Again, did not pull back into the zone. There's a target, but it actually hit the projection zone right there. Again, that's a 2 to 1 target, but it actually hit the projection zone there. The next one pulled back into the zone. Again, you can see all the waves being labeled here. Pulls back into the zone. There's your entry. Again, hits the target, the projection zone right there, 2 to 1 plus the projection zone. Okay. Now the commonality between all these markets is they're moving in a direction, right? We get traders that will even take this tool and try to apply it to a choppy market. Can't do that. It's got to have some type of directionality in the market. It's got to be moving one way or another. Here's some short trades. Again, you have one, the corrective wave 2. Hit the zone, start moving out of it. There's your entry. Risk is fairly minimal. And this trade would have went much further. Now we have these kind of, just static 14 ticks risk, 28 ticks gain. But if you're trading, you want to squeeze out as much as you can out of each trade. You get a winner, you want to, especially when it's the beginning of a wave 3 like this. You gain 28 ticks here, but you could have gained a lot more, especially off such a small amount of risk. So you always want to go ahead and leave some runner contracts on there to squeeze even more out of these trades. You can see it hit the projection zone, actually went beyond the projection zone, finished wave 3. You have a corrective wave 4 here. All right, the entry on this one, so you had a pullback into the zone, actually leaked through the zone here. Now this is a sloppy, I'll say this right off the bat, this is a sloppy entry here. You didn't invalidate, obviously, the wave 3, it's still within Elliott Wave principle here, but this one is not really based off the zones here. It's just based off a simple price action. But a potential trade there. Again, a lot more, I'll be honest, this trade would be a lot more discretionary than mechanical if you're using this tool. And then finally, you have the last short trade there. Again, this is really small, it's 5 minute, but you did have the very small corrective wave 2, and then you had the entry there. Now, if you're doing wave counts here by hand, you would say that this would probably be A, B, C type of correction. Then you would go ahead and take your entry over here. Either way, that's not too far apart here. But if you're using this tool, you can see that you had the break of the low of wave 1, risking 52 ticks, hit the projection zone there. And then again, another entry pull back into the, price reversal zone. And then another nice move to the downside. All right, this one, you're risking 52 ticks. And again, on a 5-minute time frame here. So by the time you got to this trade, most likely you're still probably in this. You probably wouldn't take this entry. You maybe add to a trade here and then squeeze it down. You can see this one worked out pretty well. Went down to the projection zone and then pulled back. All right. And just to show you exactly what this this tool can do, here is again on a 5-minute time frame here, and I had the Elliott Wave tool loaded here on the right, the left. And you can actually set a lot of customization here. So depending on what time frame that you're trading on, you can set the swing strength to any type of time frame. Again, this is just kind of an easy tool to kind of put the training wheels on and kind of help you out. But you have the swing strength here. You can use highs or lows or open and closes. If you just hover your mouse over, it tells you exactly what it does. All right, so on the smaller time frame, I like to use bigger swing strengths. I want to see bigger swings that it's calculating on the lower time frames because I don't want to see every little swing on a 5-minute being calculated. And I'm just going to go ahead and right-click on there. Let's go ahead and close this down. And there you go. You have the count of wave 1, 2A, 2B, 2C. You even have invalidation levels here. All right, so again, all this is based off of Elliott Wave principle. If it came down and invalidated this level right here, then it would go ahead and restart the count, and then this count would actually be over at that point. What you can see is ABC correction goes into wave 3, and then again, not getting too deep into it, but you can see the 3 has sub waves here. So 3-1, 3-2, 3-3. All right, all the way to 3-5, hits that projection zone here once again. And then we go into another correction here. So you actually had another opportunity, these zones right here, to go ahead and go long right there on a breakout, or just a candle reversal right there. And you go ahead and play that much higher. So you have these target zones and whatnot. And then you have the customization. So you can actually go into the wave ratios here. Wave 2, wave 3, wave 4, wave 5. So you can see wave 1 there. The top of the zone is the minimum zone retracement. The bottom of the zone is the maximum zone retracement. So anywhere from 50 to 61.8. Again, based off of Fibonacci, you can go ahead and adjust those as necessary. So if you like it a little bit higher, if you like it a little bit lower, it's up to you. Maybe you have your own calculations there. All right, if it goes beyond this red level, it's going to go ahead and invalidate the count. Same thing for wave 3. You have audible alerts here as well. Maximum zone projection for wave 3. Again, Fibonacci extensions. You can adjust those as needed, even color the bars. Same thing for wave 4. You can see how that's being calculated here. So full customization, depending on whatever you're doing with Elliott Wave. If you're getting super in depth and you want to go ahead and customize these, it'll go ahead and lay all this out for you, even the ABC corrections here as well. You have one for the bullish count, have the bearish count turned off. So this comes down to you as a trader. If the trend is down, obviously you want more of a bearish count. If the trend is up, you want a bullish count. All right, the count display, you can go ahead and just customizations here. You can go ahead and hide the historical. Oh, let's see, you can hide the labels, historical. You can just see the current count here as well. All right, so really clean up the chart for you. And again, just a lot of just cosmetics here. All right. All right, so again, this tool does a lot of that work for you. You can see as it's going forward, it's constantly calculating here. All right, you can see that you had a start of another wave here to the high, and then it got invalidated right here, and then it went ahead and restarted. Again, this is the far right edge of the chart. So again, we're kind of in more of a flat correction here. Let's go out to a 30-minute. All right, here on a 30-minute time frame here, again, you can see the 1. You have the sub waves here, the zigzag correction. All right, then you have the wave 3, which was it was really messy. Then you had that wave 5 here. All right, you can see 1 was started here. It's invalidated, so it restarted the count here. All right, and since we are talking about Fibonacci today as well, We also have this, if anybody is interested. These are harmonic patterns. All right, and just going through this real quickly, you can see that we have ABCD patterns here. All right, that are plotting here on the chart, very similar to the Elliott wave. Full customization here, ratios, all that stuff has the volume overlaid here. So even if you don't have volume on the chart, you can see the volume profile there. All right, these little speakers here are audio alerts. You can see ABCD patterns. You can go ahead and turn them off, just see the most current ones, or turn them off completely, turn them on, or just see the most current ABCD pattern here as well. All right, cipher patterns, Gartley's, Sharks 5.0, again, completely customizable here as well. I don't think we have any of those. Let's see. Yeah, sometimes you'll have patterns on top of patterns here. You can go ahead and clean that up just a little bit. All right. So we have that for harmonic traders as well, or a lot of Fibonacci's calculations there. Works the same way as the Elliott wave. Now to go ahead and wrap up, just remember with the strategy, it works well when the market is moving strongly in an impulsive manner with flat or nearly flat corrections. Breakout trades should work fairly quickly, and this is true again whether you trade Elliott wave or anything else. You want to see breakout trades really get up and go. You shouldn't have to wait all day for it to move. If you do find yourself waiting, then it's probably not a great breakout trade at that point. Maybe you need to scratch a trade and move on. If the market is moving strongly in your direction, consider leaving a runner on and managing it to squeeze even more out of the trade past your 2-to-1 target. Can't stress this enough. Don't be too rigid in your rules when it comes to taking profit. So a lot of these trades can go much. If you're an impulsive in an impulsive trade, or in an impulsive wave, I should say, those trades can go quite a bit. Okay, so squeeze as much out of those trades as you can. Don't force your opinion on the market. If you're not seeing it well, then move on to a market that is showing nice symmetrical waves. If you're trading in stocks, I mean, there's so many different stocks to pick from. If you're trading the ES and you're just not seeing it there, maybe switch over to the, to the NQ. You maybe see, it's a little bit clearer there. Move over to gold, move over to oil. Right? Again, don't force your opinion on the market. Sometimes, traders are so fixed and fixated on a certain market, they'll stand on their head just to see an Elliott wave, and it's just simply not there. And then there's gonna be days where, it's just not setting up well. Just sit on your hands, do some education, right? Just, watch some YouTube videos, catch up on, work or whatever you need to do, right? You're just not seeing that day. Don't force your opinion on the market. Look for those quality setups, quality over quantity for sure. All right, I'm going to go ahead and open up to any final questions here. I think I'm near the end of my time. And for you guys coming today, we're always trying to give away as much free stuff as possible. So I went ahead and put that in. Oh, wrong. Should have put it to the, there we go, to the attendees. All right, so everybody should have that. If you click on that, you can always check that out. There's a bunch of different ebooks. Just pick and choose whichever one you want to go ahead and go through. Again, we have a lot of different things we try to give away for free. We have Indicator of the Month Club. You can go ahead and just sign up with that on your email, and we'll give you a free indicator every month. Right? We'll give you something every month to go ahead and plug in and play with, and it might be something that's right up your alley. Other than that, we're always trying to provide resources, free or extremely economical for traders to go ahead and get in and, get to work when it comes to trading. Henry, let's go back and through some of these questions here. Can you show us how the count will look like in a current market? Let's go ahead and turn that off. Yeah, we're here in the ES. So yeah, here's the count here in the current market. We're down here. I need 5-minute. And yeah, that's the current market right now, just a little bit, really no direction to it. Sometimes you can go ahead, put this to very big. It'll go ahead and update the account here. Looks much, that's why I like the, it's setting up, if you're on a smaller time frame, looking for you know, bigger swing points because it looks much cleaner, as you can see here. Much cleaner. And you can see that we got an ABC correction currently going on, at least on a 5-minute. Jill says, Elliott wave drawing is subjective. Everyone draw them differently. Absolutely. I couldn't agree more. Yes. You can give me 10 Elliott wave traders and tell them to diagram a chart for me, and I'll have probably 10 different ways to look at it. So yeah, it can be very subjective, and that's why I try to keep it as simple as possible. We're looking for impulse waves in the market. You know, you see an impulse wave, you will look for a breakout of that impulse wave high, or very simply like here. You know, you have the first wave here, corrective. You look for that breakout. You have that breakout candle right here. Okay. You can use these invalidation levels as stop levels here, as you like some of our traders do. All right, but you know, put your stop, you know, at a reasonable distance away, and then you can see, again, just looking for those impulse waves. We do have traders that will go ahead and trade these corrective waves. I'm not a big fan of it unless it's really obvious to me. There's like an obvious edge there. I'll go ahead and take it, right? So the most common one here is actually taking advantage of the C wave. So traders, you know, you get the A, B, they're looking to go ahead, they're looking for a breakout. They'll probably go ahead and get short right here. You know, they'll probably get short right there, or unless they have like maybe an engulfing candle here. If they have a bearish engulfing, traders will definitely get short there and at that B leg to go ahead and take advantage of that corrective wave. This one's actually not bad. It actually stands out pretty well, but I like the clear. You know, I'm not a big fan of trading within the corrective wave. It just can kind of get choppy and messy, as you can see there. But we do have traders that will go ahead and look for that A, B, and take that C leg. All right. All right, I don't see any other questions here. All right, David.